Hello everyone, this is Terry with Futures.io, and as always I'd like to thank you for joining us today. It's my pleasure to welcome back Ryan Curran for today's webinar, Tax Topics for Traders in 2019. If you have questions, please feel free to type them into the questions box throughout the webinar, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Ryan, and you'll get the pop-up again to share your screen. All right, looking good. She's all yours.
Great. Thank you, Terry. Hey, everyone. Hope everyone's doing well. Happy New Year. It's good to be back here for another year of presenting this enthralling information here about tax updates for traders. So I'm going to jump right in here. A little bit about me. I am both a CPA and an attorney. I run my CPA firm here in New Jersey. We are primarily located in New Jersey, but have a small satellite office in New York City and deal with clients all over the country. We also deal with a lot of expats, a lot of U.S. citizens that are residing in Europe and other parts of the world. We help take care of their U.S. tax obligations. As an attorney, I have a kind of a boutique law practice, and I focus primarily on taxation, in addition to some partnership structuring and business law. Just jumping into our summary here. So I'm going to talk about really four main topics. Those who are veterans of these trader tax talks are probably very familiar with mark-to-market and trader tax, but no tax update is really appropriate or complete without these in here. So they will be present. We will speak about them briefly. The primary items that I wanted to talk about, though, is really the changes to the tax code, this 20% qualified business income deduction and how it relates to traders, in addition to these new investment vehicles called qualified opportunity zones, which allow persons that realize capital gains to essentially defer the recognition of those gains for a long period of time and potentially avoid taxation on income generated from those gains. And we'll dig into that in a little bit. So just jumping right in here to the 2018 tax plan and its impact on traders and taxes in general. So this new tax regime that was passed in late 2017 is effective for 2018 and will remain effective through the end of 2026. So we essentially have 8 years of these lower tax rates and changes to the tax code that are very applicable to, not only traders, but really all taxpayers in the United States. So generally speaking, tax rates across the board have been lowered and tax brackets have been expanded. So the previous tax rates, the band for federal purposes was at the low end 10%, at the high end 39.6%. Under the new tax regime, the low end is still the same at 10%, but the high end is actually 37%, which reflects about a 3% reduction. In addition, the actual brackets at which these tax rates apply were widened. In other words, you can make more money and the highest ends of your income is not going to be taxed as aggressively as it was under the prior tax code. So, our general research and evaluation for our existing clients is showing approximately a 2 to 3 percentage point overall federal tax decrease on average. These income calculations and bands also cover the inclusion of short-term and long-term capital gains and ordinary income and loss from trading. It all gets factored into the tax brackets and ultimately the tax rate that one will end up paying. Some other changes. Business deductions have been changed. So interest expense. This is relevant to traders that are using leverage to trade, put on more trades than you otherwise would with just your equity. So if you're generating significant investment interest, your investment interest deduction is limited to 30% of effectively of your taxable income. So if you, just using examples here, if you have $100,000 of profit and you've generated $50,000 of investment interest, you're only able to use $30,000 of that investment interest to reduce your $100,000 of taxable income. So that represents a pretty major change for traders that use leverage to generate profits relative to the old tax plan, where there was really no limitation on the interest that could be deducted. Other interesting changes here: entertainment deductions. So, if you are taking a trading partner to play golf, the actual round of golf is no longer deductible under the new tax regime. Interestingly, if you have a meal while conducting the entertainment activity, while playing golf or while seeing a show or seeing a sporting event, the meals and drinks associated with it are still deductible, but the actual entertainment item itself is not deductible. So kind of a interesting change, and you need to be very careful when you're doing your expense reimbursements or putting together your P&L for the year, that you make sure to highlight any entertainment costs that you might have deducted in the past, because they're not going to be deductible in 2018 through 2026. Another big change is the net operating loss changes. And this is very relevant to traders that may have a mark-to-market election in place in the first year or two of trading, where they may incur significant losses. Under the prior tax regime, any net operating losses could be used 100% to offset future income. So if you generated a loss in 2017 of $100,000 and you carried forward that loss, which you were allowed to do, and then in 2018 you generate a profit of $100,000, under the old tax regime, you're paying $0 of tax because you've used the $100,000 loss from 17 to offset the $100,000 gain from 18. Under the new tax regime, take that same $100,000 loss, you're only allowed to use it to absorb 80% of any future profits. So let's use examples again. I've typed one out here. Let's say in 2018 we've generated a $200,000 loss from trading under a mark-to-market election, which is going to be considered an ordinary loss. Then let's say in 2019 we've generated $100,000 of trading profit. Under the old tax regime, the entire profit in 2019 would be eliminated. Under the new tax regime, 80% of that profit is eliminated, and the remaining 120,000 of the 2018 loss gets carried forward. So it's a change to the tax code that basically forces businesses that have had poor years in prior years to pay some tax in future years if they generate some profits. Next up, and this is really a fascinating topic, and in my opinion probably the best proviso of the new tax plan, is this 20% qualified business income deduction. If you watched this webinar last year, I touched on this briefly. There have been a litany of regulations that the IRS has released and the Treasury Department has released in the summer of 2018 that clarifies how this will be applied. So I want to go through this because it is, again, extremely relevant. I'm going to use some examples here. So trading entity A has $100,000 of trading profit after W-2 wages of $50,000 paid to its sole shareholder, individual B, who's a single taxpayer. Individual B's only source of income is W-2 wages from entity A and a K-1 of $100,000 of trading profit from entity A. So in other words, individual B has $150,000 of taxable income for the year in question. Individual B reports his W-2 wages on personal tax return, reports profit of $100,000 via the K-1 that was received. So the way the 20% deduction works is the actual profit from the K-1, the IRS has allowed a deduction of 20% of that K-1 profit off of taxpayers' adjusted gross income. Okay, so in this situation, 20% of the $100,000 trading K-1 is going to be $20,000. So we aggregate the wage and the K1 profit. So 50,000 and 100,000 leaves us with 150. We may be allowed to deduct a $20,000 break for this qualified business income tax break off of that 150, which results in $130,000 of taxable income. Naturally, in the tax code, there are numerous exclusions and clarifications and qualifications. So we're going to talk about those a little bit. So the IRS says that in order for any taxpayer to get this break, you need to have W-2 wages that the business is paying. And the break is limited to 50% of those W-2 wages in this context. So first you do a calculation of, you take 50% of the $50,000 wage, that leaves us with $25,000 of eligible wage. We then take the 20% qualified business income deduction, which is the $20,000, and that comes from taking 20% of the $100,000 profit from trading. If the $20,000 qualified business income deduction is less than 50% of the W-2 wages, and in this case it is, then the full break is allowed. Okay? So this is why, let's take a common trading entity where one is structured as an S corporation and they're taking a salary from their trading profits. We need the salary to be set at a level such that the taxpayer will generally be able to take advantage of the full power of this qualified business income deduction. So it's crucially important that wages be structured in such a way to take advantage of that break. Let's assume that we do satisfy the wage limitation as I've outlined here. There are still further limitations. So the general rule is that a qualified business income deduction is allowed from a specified service, trade, or business, and that's defined in the tax code, and I'll get to that shortly. It's fully allowed for a single taxpayer with adjusted gross income up to $157,500 and married taxpayers up to $315,000. So what that means is if a single taxpayer makes, on an adjusted gross income basis, less than $157,500 and they meet this W-2 wage threshold that I've mentioned, there's no restriction on them being able to take that deduction. However, if the single person's income goes above $157,500 up to $207,500, and if the married person's income goes from $315,000 to $415,000, there's a phase out that takes place which can completely eliminate the qualified business income deduction. Okay? And now this only takes place for these specified service, trades, or businesses. And IRS has, in their regulations, promulgated what that means. So the general rule is that any trade or business whereby the profits are derived from the skill of the operator, the owner of the entity, that's considered a specified service, trade, or business, and it's subject to the limitation. If a business, it does not qualify as a specified service, trade, or business, there is no limitation. The issue with trading entities, and this isn't clearly defined in the tax code, but to me it seems quite obvious that if the specified service, trade, or business covers a trading entity, because the skill of the trader is what's going to ultimately drive profits. That's what IRS or tax court will look at in making a determination. But in any event, the statute does clearly define, for example, accountants, attorneys, doctors, engineers, all qualify as the specified service, trades, or businesses. Again, traders aren't explicitly mentioned. Financial services and investment managers are mentioned. If a trader is using primarily, algorithms to trade, arguably that wouldn't qualify. If the trader is the one writing the algorithms, then the IRS would likely view it as this SSTB, the specified service, trade, or business. But generally speaking, what I'm advising my clients is that if you are an active trader, you are going to meet this definition as an SSTB, and these limitations on adjusted gross income are going to apply and are going to potentially eliminate or reduce the benefit that one gets from this 20% QDI deduction. But in any event, it is there, and for traders that are kind of finding their way, as it were, and starting to make some money, this does give you at least a pretty nice benefit. Just to give you an illustration of what businesses would qualify for an unlimited break. So, take a fast food operator or an owner of fast food chains. Those are the kinds of businesses that even if the owner of those businesses is generating a $10 million profit per year, arguably they're going to get a 20% break on that entire $10 million. Okay? Just because the money that's made is primarily from labor, not their own labor. It's really just that, them operating their business, whereas trading profits and professional services are derived from, a person's skill and reputation. Next up, this is a really neat proviso in the tax code, very interesting, and a ton of material being released on it, and potentially really, really a potent and unbelievable tax break. So there was this mandate basically issued to governors of all the 50 states in the United States under the new tax plan, and the tax plan essentially directed each governor to designate certain areas of their states as opportunity zones. And the general thought is that certain urban areas or blighted areas should be treated as opportunity zones. And provisions were written into the tax code to incentivize investors and business people to put money into these opportunity zones with the hope of stimulating them. And the carrot that was provided is really fantastic tax deferral opportunities on capital gains generated. So at the end of the day, capital gains of any kind qualify for deferral, and these capital gains can be reinvested into what's called a qualified opportunity fund. Okay, and we'll go down the laundry list here. If you are trading securities not under mark-to-market election and you're successful, you're generating capital gains, right? And short or long-term capital gains do qualify for this deferral. So it really doesn't matter how long you're holding the items for, as long as the character is capital gain in nature. And we're talking, futures contracts, Section 1256 contracts that are generating short and long-term capital gains. Again, any trading that's not mark-to-market is going to generate capital gains, with the exception of currency trading. But there's a potential if you have profits and you're looking to potentially deploy that money into something that's, not correlated to, your normal trading activity. If you wanted to buy real estate, for example, you can take the capital gains that's recognized on your performance for the year and put that money into this qualified opportunity fund and defer the tax on it for years. And I'll walk through kind of the deferral mechanisms in a bit, but just to kind of set the table here. Now, a qualified opportunity fund can be any investment vehicle. So you can form an LLC yourself that you're the sole owner of, and that can actually be treated as a qualified opportunity fund under the code. In order for an entity to be treated as a QOF, qualified opportunity fund, it must invest 90% of its assets in real estate in a QOZ, qualified opportunity zone, or it may start a business in a QOZ and deploy 70% of its assets in a business located in a QOZ. Okay, now, many of you who may be familiar with this or are paying attention here may be thinking, why don't I just take some capital gains off the table and start a trading business in a QOZ? I mean, in theory, that's a brilliant strategy, and it would be fantastic if it was allowed, right? But unfortunately, it's not. And the reason is the regulations specifically say no more than 5% of a qualifying business's assets can be financial in nature. So securities, unfortunately, would qualify. And that would end up disqualifying one who's looking to start a business in a QOZ. With that said, part of my practice, in addition to providing, tax advisory for traders, I have in-depth real estate experience, and real estate is, has been at a fever pitch of late. So, to the extent that anyone on the call is, potentially interested or looking for an investment opportunity, having knowledge of this is crucial, particularly if you are a trader that's successful, because more than likely you have capital gains to defer. So some of the other benefits of having these capital gains to be deferred. So I'm going to use an example here. It's pretty detailed. So taxpayer A generates $100,000 of capital gains in December of 2018 from trading 1256 contracts and wishes to deploy such capital gains into real estate partnership in a QOZ. Taxpayer A starts an LLC and funds LLC with $100,000 of capital gains. I wrote here at any point up until June of 2019. The reason I wrote that is after realizing the capital gains, you have 6 months from that realization date to deploy the money into a qualified opportunity fund. And again, to reiterate, a qualified opportunity fund sounds fancy, but it's very simple. It's really just you forming your own LLC, as long as the LLC is going to invest 90% of its assets in qualified opportunity zone real estate, or 70% of its assets in a business in a qualified opportunity zone. Okay? Another point that I did not mention here, but that even gives this more potency, is once the money gets into the fund, you can actually wait 30 months from the 6-month time frame to deploy the capital. So in practical terms, you have effectively 3 years after realizing the capital gains to deploy the money pursuant to the tax code to get your deferral in the immediate tax year. Okay? So as long as taxpayer starts this LLC, funds the LLC with the capital gains, the taxpayer, you would make an election on Form 8966 on your personal tax return or a partnership tax return, and that's the certification mechanism that IRS looks for in order for them to be noticed by you that you are a QOF and you're electing to defer these capital gains. Okay? So let's continue to walk this through here. So let's assume that we invest the money, or we decide to invest the money by June of 2019 into the QOF. Okay? You don't have to pay the capital gains tax on your 2018 tax returns. In fact, you have an 8-year deferral period on any capital gains that are reinvested into a QOZ. So in other words, if you're making the deferral in 2018, you don't have to pay any tax on it until 2026. So that's fantastic in and of itself. But when you really factor in time value of money, as those of us in finance will really understand, that's where this has a tremendous benefit. Now, another point here is these rules, as I mentioned earlier, are in force from 2018 to 2026. So the way it works, if you decide to, if you have a fantastic trading year in 2026 and you decide you want to get into real estate in 2026 or something along those lines, you would get your deferral in 2026 and you wouldn't have to recognize the tax for 8 years from 2026. So you wouldn't pick up any tax until 2034 in that example. There are some other benefits for holding the interest in the LLC for certain time frames. There are certain hurdles. The first hurdle is 5 years. If you hold your investment in that LLC for 5 years, the taxpayer will get a discount of 10% on the gain to be recognized. So in our example, we have $100,000 of capital gain that has to be recognized in 2026. If we hold the interest for 5 years, only $90,000 is recognized, not $100,000. The other $10,000 is basically a tax-free gift from IRS to the person with the LLC interest. Next, if you hold the LLC interest for another 2 years, which is 7 years total, you get another 5% discount, another 5% tax-free gift here. So instead of recognizing $100K total, you're recognizing $85,000. Then the final hurdle, and the best one, if you hold the LLC interest for 3 years after the 7, so a total of 10 years, all of the upside related to the investment in the LLC is tax-free. So saying it a different way, and think of this in trading terms, you fund LLC with 100K, your basis in that LLC is 100,000. Let's say the real estate or the LLC itself, the property value appreciates fivefold to $500,000 after 10 years. And then you sell the interest for 500. You're not paying any tax on the difference between the $100,000 of capital gain you originally put in and the $500,000 sale price. It's all tax-free. So it's a tremendous break, and I think it's very relevant to traders who, again, might want to think about some diversification, getting into real estate or some kind of other business venture with capital gains from trading because of these rules. And my prediction is that this will never exist again. So take advantage of it in the next 8 years. Just highlighting some other items that were changed with the new tax regime. So previously, you were able to deduct unreimbursed employee business expenses, and this was relevant to traders who are W-2 employees who are also trading actively, who might wanted to take advantage of certain telephone expenses, auto expenses, travel, etc. There was a form 2106 that was used previously. That's been totally phased out. It's very relevant to an S corporation owner. So again, your typical trading entity, that's an S corporation. The S corporation itself, to still get the benefit of these unreimbursed expenses, it must reimburse the shareholder directly for the expenses. Shareholders cannot deduct unreimbursed expenses any longer on Schedule A, which is the itemized deduction schedule, on your 1040 form. So if the S corporation does not have what's called an accountable plan set up, all those unreimbursed expenses are going to be gone. So it's very crucial that if you have not paid attention to this as an S corporation owner, that you do. You make sure you have this in place. You make sure that the corporation itself is actually reimbursing you on a monthly basis or periodic basis for expenses incurred. And again, for it to be valid, the S corporation currency must change hands. Whether it's a bank-to-bank transfer from the S corporation account to you personally, that's fine, but it has to happen, okay? Miscellaneous itemized deductions have been removed. So to the extent that anyone here, and I doubt this is applicable, but it's worth mentioning because it's in the investment space, to the extent anyone here is paying advisory fees on any kind of managed accounts. If you have a trading account and you have another wealth manager or investment advisor who's managing money, the advisory fees are gone, okay? As a professional trader, it's arguable that you can utilize those fees as a business expense, which would be either deducted on one's corporation return, partnership return, or Schedule C on personal return. But that is very gray, and it has not been, no regulations or court cases have been litigated or promulgated to my knowledge. So again, it's a gray area. I think it's reasonable to think that we can probably take advantage of that, but again, it hasn't been scrutinized by tax courts, so it's very, very hard to predict what tax courts say. Another major change, which I'm sure everyone's heard about, is the limitation on state tax and real estate taxes. So you're now allowed only a $10,000 deduction for real estate or state income taxes, whereas previously it was unlimited. So the practical effect of this is taking a home office deduction is even more crucial now, particularly if you're in a higher tax jurisdiction, Northeast or West Coast. Washington State notwithstanding, since there's no state income tax. But in any event, taking a home office deduction is going to allow you to deduct at least the business portion of real estate taxes. So again, these are things that you should be thinking about. I've put here a link to the full, 600-page document of the tax reform if you really want to read it. God bless you. Good luck. But it's here anyway, just for completeness sake. So that kind of concludes our, tax update with what I think are very, very relevant points towards traders. Overall comment before I dig into mark-to-market here. There really hasn't been anything earth-shattering in the way of, how securities are taxed. Like, none of that's really changed. That stuff's all stayed the same. The big benefits have been provided for small businesses, and to the extent professional traders are conducting a professional activity that is a trader business, that's where you're really going to benefit from these new deductions. And that's why it's really important to highlight those. So next up, mark-to-market. So I'm going to go through this. Again, I'm sure if you guys are kind of experts in this or in webinars, then you're aware of it, but humor me and let me go through it. So mark-to-market is an election that's made under IRC Section 475. It basically eliminates the capital loss restrictions for traders. So generally, if you don't make this election, you're limited to $3,000 capital loss for the year in question. So, if you have a bad year and you lose $100,000, you're only allowed to deduct $3,000 of that normally. If you have a mark-to-market election in place, you're allowed to deduct $100,000 instead of $3,000. So it can be very useful to use that to offset other income that you have, whether it's dividend income, interest income, real estate income, other kind of business income. So it can be very beneficial to make this election. And the general gist is that the treatment of securities as capital in nature, in other words, as assets that give rise to capital gains or losses, is eliminated when a mark-to-market election is done. Tying this back to our qualified opportunity zone comment, mark-to-market election will also eliminate the ability for anyone to use profits from trading to reinvest into these qualified opportunity zones, because they're technically not capital gains any longer. Okay. Once a taxpayer makes a mark-to-market election, you need to get it revoked by IRS in order for it not to be used any longer. And that actually requires petitioning IRS, writing them a letter, maybe even getting a private letter ruling, which is essentially IRS charging multiple thousands of dollars to give an answer to a taxpayer. More or less, it's a shakedown. But in any event, that's how the mark-to-market is unwound. So you need to be very sure that you want to do it before you do it. But it is flexible in that traders can have, let's say you have a business trading account and you have a personal trading account. And the business trading account is titled to an actual entity, whether it's an LLC or a corporation. The mark-to-market election can be made just with respect to the business and not your person. So again, if you are thinking about this the right way and you're strategizing where your positions are held, you can potentially have the best of both worlds, as it were, and have mark-to-market on one pool of securities and ordinary, the capital gains treatment on the other pool of securities. So it's something to think about. Mechanics, it's pretty straightforward. As an individual, you have to attach a statement to your tax return, and it must be done by the due date of the prior year tax return. So in other words, if you want to elect mark-to-market if you wanted to elect mark-to-market for 2018, you had to make the election by April 15th of 2018. Conversely, if you want to make the mark-to-market election in 2019, you need to make the election by April 15th of this year, 2019. Okay? A business, it's the same kind of rules, except with an S corporation and a partnership, the due date is 1 month sooner, just because that's when the actual underlying tax returns are due. Okay? When you file a mark-to-market election for a business, you need to actually file a form with IRS called a 3115. And that's it's a pretty big deal. It's a daunting form, and it has to be filled out correctly or else it'll get kicked back. But because it's so permanent in nature, this is why once it's accepted by IRS, you have to get approval from IRS not to use it. So again, you just need to be triple sure that you want to do it. The good thing about the election is it's as of right, which means that if you filed it correctly, it cannot be denied. Mark-to-market elections made in several different ways. With a new business, there's no formal election, but if you file your first tax return and you are reflecting mark-to-market treatment on your tax return, you are a mark-to-market taxpayer then in the eyes of the IRS, and you need to continue to use it. Okay, sole proprietorships and single-member LLCs, same thing. You know, there's really no hard and fast rules that I'm aware of with this mark-to-market election for these particular types of entities. Generally speaking, we just recommend that one of these two organizational types, just keep the same kind of statement of election that you would as if you had a corporation or a partnership. So, you know, you just need to make sure that you have your documentation, your files in order. Issues with making mark-to-market. Late filing relief. There is no reasonable relief for late filing of mark-to-market. There are situations where IRS has granted it, but generally speaking, it will not be done if it's found to prejudice the IRS. And really what that means is if your tax liability would be lower, if IRS grants you a late mark-to-market election, that prejudices the IRS, and they're not going to grant it. So if you're late in the election, just forget about it till next year. In my opinion, just forget about it, and then just, you know, make sure you do it in time for next year, just to again avoid IRS scrutiny and the inevitable rejection. I mean, there are some, you know, articles and stories and private letter rulings out there from IRS, but you have taxpayers that are paying, I mean, tens of thousands of dollars to obtain those private letter rulings from IRS. And even then, it's not a guarantee. So the point is, you need to be timely if you're going to do it. Another potential issue is you have to be aware of the types of securities that you're holding in an account that's going to be affected by mark-to-market. Just because one of the side effects of mark-to-market is the recognition of unrealized gains or losses on securities. So if you have positions at the end of the year that have significant unrealized gains and you make a mark-to-market election during the year and you're not aware of it, you're going to have a problem because you're going to have to pick up as taxable income all of those unrealized gains. So again, it's just really about being super aware of all your positions. Futures traders. So 1256 contracts are really beautiful just because they have the bifurcated capital gains treatment, right? So you want to make sure that you are not losing that. And if you are just making what's referred to as a blanket election on all the securities, you're going to lose the benefits associated with 1256 contracts. So our recommendation is typically trade these contracts in a separate account. Now, if you are experiencing significant losses, then you just have to weigh kind of the benefits versus the risks. Because if you have these significant losses, even in a 1256 account, you're going to want to potentially make the election in order to take advantage of the losses associated with that account. But if tides turn and you start generating significant profits, the 1256 contracts, the tax benefits associated with them from capital gains standpoint are going to be gone. That's why I've noted here proper segregation is really crucial. Jumping in trader tax status at this point. So trader tax status is really a term not necessarily defined by IRS, but it's really evolved through tax court and IRS guidance and such. And it's really defined as someone who's carrying on the active trade or business of trading. Okay, and it's viewed in the eyes of IRS, assuming one qualifies, as any other business. So you're able to deduct, home office costs, internet subscriptions, health insurance, any of the other deductions that are going to be afforded to any other business. Most importantly, in my opinion, is the benefits that retirement plans can provide. So just to give you an example, you have a SEP plan, which self-employed person can do. You can put up to $55,000 a year into that account. You have a simple IRA, which is, just that. It's very simple to set up. Low administrative costs, but the contribution limits are much less. Instead of $55,000, you can only put in $12,500. Now, I think one of the most interesting things that you can do in a professional trading business is super fund a Roth 401k. I mean, this is really, really powerful, in particular if you are a successful trader. So what you can do is you can have a individual 401k, assuming you're the only person in the business, an individual 401k set up. You can make you can have essentially a Roth 401k, and then you can use what's called after-tax contributions, and you can fund the after-tax account up to $55,000 a year, and that entire after-tax account can be converted to a Roth. So you can have situations where you're putting away, if it's structured properly, where you're putting away $55,000 a year into a Roth 401k. And if you're trading that account and you're successful in trading that account, or even if you're just investing it into the S&P 500, if you can put away $55,000 a year into a Roth account for 10 years, you're going to have millions of dollars of tax-free money when you retire. Assuming, depending on your age, obviously, but that's a tremendous, tremendous benefit. So just to give a little bit of background and clear up some, I think, common misconceptions about trader tax status. So many people think that making a mark-to-market election automatically means that you're going to qualify as trader tax status, and that is not true. It's independent processes. So trader tax status is much more facts and circumstances based. It's much more gray, whereas mark-to-market is very black and white. If you follow the rules that the IRS prescribes for mark-to-market election, the election will get accepted and you're mark-to-market under the tax code, and you file your tax returns using that methodology. Whereas trader tax status can be challenged by IRS and denied. And again, that really depends on each person's individual facts and circumstances. So our general rule here to take advantage of trader tax status is you really should be thinking about forming a separate entity. Generally speaking, and this goes for any business, not just trading, but Schedule C's on taxpayers' individual tax returns are just much, much more likely to get audited. In the thousands of tax returns I've prepared, I've seen one S corporation out of 2,000 business returns get audited. I had nothing to do with the S corp, but I actually represented the client on helping them get out of the audit issue. But in any event, I've only seen it happen once in the thousands of business tax returns I've prepared. On the personal side, it happens much more frequently. For whatever reason, it's just, I guess, IRS internal revenue manual stuff, but you really just want to get that entity off of your Schedule C. And like I mentioned here, this just kind of reiterates what I was saying. S corporation, partnership, these are the ways to keep your audit risk down. Retirement accounts are available, health insurance available. Furthermore, this is another good point that's really not paid attention to too much. But if when a taxpayer has a Schedule C on 1040 form, it is not as clear to IRS what the taxpayer is doing, especially if they have a couple different Schedule Cs. Whereas if you have a separate entity that's, XYZ trading, and you're using the correct, what's called the NIICS code, if you're using that code, it's going to be very clear to an IRS agent looking at your return that this is a trading specific entity. It just kind of passes the smell test initially. Obviously, the tax authorities can dig into it more, but you're taking the right steps from the start to kind of head off any kind of inquiry just from a first look at the entity. As I mentioned, qualifying is highly fact-based. 1,000 trades a year has been floated as a safe harbor by a number of commentators. I suggest at least one trade a day. You need a regular pattern of trading. Certainly maintaining a calendar, clock in, clock out. I mean, you really have to treat it like a job. Keep a timesheet. If one is a full-time employee somewhere and is generating significant losses from trading consistently, and especially if that person's using Schedule C to deduct those losses, probability is quite high that it's going to get audited and disallowed. So these are the kind of factors that need to be considered when considering if you want to elect trader tax status on your tax return. Overall, you have to maintain the appearance of a business. Regimented, documented, timesheets, etc. I've cited a tax court case here for reference. You can take a look at it if you want to, read some boring tax law. But that's a basis for, a lot of the support for what I'm putting down in these sheets. And that really sums up what I wanted to talk about today. So, obviously I'm available if you want to talk about personal business tax returns. I think just from the context of the conversation, especially around the qualified business income deduction and opportunity zones, I'm excited about this stuff and knowledgeable about this stuff. So, if you want to lean on me for advice or questions, I'm happy to answer anything. Okay, and then obviously we need a disclaimer here. So I'm not providing any specific advice, tax advice or investment advice. You have to vet this stuff yourself. This is really meant to be a guide and ultimately help you think about these kinds of topics, help you become more prepared, help you understand tax changes, so on and so forth. Terry, you there?
Yep. All right, let's see.
I guess we can open up some Q&A.
Yeah. You can leave it on that conclusion slide if you want.
Sure.
What is the best choice for asset protection, salary benefits, not direct pass-through, as I would like to build capital in California?
The best choice, not a pass-through?
Yeah, for asset protection, salary and benefits.
C corporation all the way.
Okay.
But that's really the only entity that's not going to be pass-through. But the C corporation here, you'll be able to take salary, benefits, etc. And if you make the mark-to-market election in the C corporation, you will eliminate the typical negatives that can be associated with holding actual capital assets in a C corporation. You can actually get penalized if you're holding securities in a C corp. So if you make a mark-to-market election in C corp, you'll kind of flout those rules.
Okay. It says if it was a capital loss with a $200K carryover. I think this was in response to one of the slides that you were doing the example.
I think there was a net operating loss.
Yeah.
So it's not a capital loss, it's a net operating loss. So capital losses are going to be available to carry forward regardless. So if someone generates a $200,000 capital loss, and then they generate $200,000 of capital gain the next year, it can be fully netted out to zero.
Okay.
A net operating loss is generated if someone makes a mark-to-market election because it's creating ordinary loss. And the ordinary loss is subject to that 80% limitation that I put in the slide.
Okay, got it. If you have a large capital loss carryover, should you wait until it's used up before you elect mark-to-market?
You don't necessarily need to if you're electing mark-to-market in a certain basket of securities. So using the example I gave earlier, if you have a personal capital loss carry forward and you have a personal trading account that's not marked to market, that's generating capital gains, and it could even be capital gains distributions from mutual funds or something like that, you want to be able to utilize those capital losses. So any mark-to-market election should be made at an entity level in that example. So you'd set up a separate entity to do your mark-to-market trading in. That entity can have mark-to-market ordinary income or loss. But you want, on the personal side, you want to be able to harvest that capital loss. So you want to keep at least some trading capital in nature to utilize the losses.
Okay. He says, I have a single member Delaware LLC and have a generalized state tax question. How are state taxes applied when you're trading while traveling through the states or living in several states throughout the year? Is there a business setup that helps clear up any messy state issues?
So what you're going to want to do is, this question always comes down to domicile. You have to be able to demonstrate where you intend your tax home to be. So if you have a Delaware entity and you have, say, a Delaware driver's license, that's usually a good place to start. Even if you're living in different states, you can generally get away with claiming Delaware as your domicile. I mean, if you're going to travel around the states and conduct this business, I would suggest headquartering yourself, domiciling yourself in a state tax-free area like Texas, Nevada, Washington, etc., Florida.
Okay. When putting the profits into an LLC and purchasing property, can a person live in one of the houses that are being purchased?
There cannot be personal use. No. So with one caveat, if you're buying a multifamily residence, there's an allocation calculation that's done, but it can generally be structured if you're buying, say, a three-family home or something like that, that the capital gains that you're putting in to buy that property, you can get away with deferring the tax on those if you're living in one of the units. But if you're buying a single-family home, it's generally a no-no.
Okay. What is the best way to structure a non-operating foundation charity from futures trading in California for philanthropic purposes, not hiding assets or deferring taxes?
Can you repeat the question?
What is the best way to structure a non-operating foundation / charity from futures trading in California for philanthropic purposes, not hiding assets or deferring taxes?
So any foundation, there are certain rules that need to be maintained from IRS in order for a foundation to be honored. So you have to give 5% of your net assets each year to charitable causes, and there has to be a board. There's no, from my standpoint, there's no, better way to do it. A foundation itself is fairly complicated, but you just need to make sure that the foundation honors the IRS regulations. And again, the primary requirement is this 5% of net assets being given away each year. So if foundation has $1 million of assets, at the end of the year, you have to be giving $50,000 away for philanthropy.
Okay. Okay, one guy says, what if I'm in the UK most of the year and my domicile LLC is based in California?
Is this person a UK citizen?
No.
Okay. So they're a U.S. citizen. They're in the UK most of the year. Domicile California. I mean, they really have to file a California tax return to report the trading activity for the year. They're filing a federal and a California tax return. This is, again, a great example of, it might be better to re-domicile in Washington State or Nevada to avoid state tax.
Okay.
Well, I'll offer one more item on that. So in that situation, if you're not spending 183 days a year in California, the probability of California pinpointing that and assessing tax is very low. What I'm saying is that if you look at the definition of domicile and how it's applied, if California is your quote-unquote U.S. tax home, California can potentially exert tax jurisdiction on you. So you may want to preempt that and reorganize in one of the states I mentioned. Wyoming's another good example, just to have domicile outside of California.
Okay. Next one says, did I hear it correctly? If I'm only trading futures contracts, I should not ask for an MTM designation since it's already done.
So futures, the realized profit and loss from futures is what ends up showing up on the 1099-B at the end of the year. So, if you have unrealized items in your trading account at end of year, that's where you need to be careful with evaluating whether mark-to-market makes sense or not.
Okay. All right, I think that's all of the questions. All right, thank you for the webinar, for the information, and for spending some time with us this evening, Ryan.
My pleasure, guys. Thanks, everyone. Bye-bye.